Welcome back to the Gray Report. Again, let's get right into this latest multifamily report from Yardi Matrix. It's the Yardi Matrix September report. Yardi puts these out every single month. We cover them not only on the Gray Report podcast, but also our newsletter, which we put out every week, every Thursday. Sign up at graycapitalllc.com. We do it as a free service to try to get the best and most latest up-to-date research reports in your hands, covering multifamily, commercial real estate, the macro economy. So reading some of these headlines are a continuation of some of the things we've been talking about in the past few weeks. And I quote, with demand and economic growth starting to show signs of cooling, multifamily rents hit a snag in September. The average U.S. advertised rent fell $6 to $1,750, while year-over-year rent growth fell 30 basis points to 0.6%. But I think, end quote, hitting the nail on the head, continuing, the $6 drop in advertised rents was the worst September showing in more than a decade. Properties and markets with an overhang of new supply are offering concessions and or cutting advertised rents to attract tenants. But also, it's not smooth sailing for build to rent. We may have thought the build to rent segment, which is attracting maybe slightly middle-aged and older millennials looking for more of that single family home environment, very popular asset class. It's not smooth sailing in the BTR world as well. Single family build to rent advertised rates also took a hit in September. The average BTR advertised rent dropped by $15 in September to $2,194, while year over year rent growth, the year over year growth rate fell 60 basis points to 0.0%. So this again follows the theme that we've been covering the last several episodes of this podcast and newsletter, which is a slowing market. Now we're getting into the slower leasing season. Everyone is at school. A lot of those big household decisions have been made, but we know the amount of uncertainty in the economy that's permeated down to the housing market is not encouraging too many people to make decisions whether to move. And in general, that's preventing a lot of velocity of any type of transaction, whether it's a rental or a single family home for purchase, or even just business investments, whether it's a business owner hiring or making some of those larger capital investments. The question that many ask is that creating a lot of pent-up demand? I think the answer is possibly, but there's not exactly a ton of evidence to say, when that demand might be unleashed. The government shutdown that we're in currently, I don't think is helping the situation, adding on to uncertainty driven by tariffs, inflationary pressures, geopolitics, and just general uncertainty. So again, just looking at this chart going back from September 2023, looking at national rents, there has been not a lot of movement, relatively stagnant. Some growth since September 2023, but not a whole lot. Let's take a look at some of the year-over-year rent growth. Coastal and Midwest markets are continuing to lead. In fact, when I was taking a look, I think about of the 12 major markets that have posted positive rent growth, I want to say about 6 to 7 of those are in the Midwest. The remainder are in the Northeast. And then we have San Francisco out on the West Coast. So New York City is kind of taking the top spot for rent growth, followed by Chicago, the Twin Cities, San Francisco, Philadelphia, Kansas City, Columbus, Detroit, New Jersey, Boston, Indianapolis, Baltimore, before you get to the national average of 0.6% rent growth. And that's across all asset classes. So that's taking your lifestyle, which is more of your A-class properties, as well as your what Yardi calls renters by necessity asset classes, which can be a combination of B and C, maybe a little bit of A minus. We all know that there's a lot more folks in that renters by necessity class than lifestyle, because renting just isn't as much of a choice as it was maybe a couple of years ago prior to interest rates being as high as they are. When we break down the renters, the lifestyle asset class versus renters by necessity, we see a little bit of change in kind of the rent growth leaders. New York City is taking this top spot on either category. A lot of that is driven by But folks are coming back to New York City. They're looking for employment. There's a lot of return to office. A lot of people who, maybe moved out into the country. Maybe they moved out into the Catskills during COVID. Well, they're coming back. And I think there's also this pressure of, I think, new college graduates. People are always going to be wanting to move into New York City. But also, I think the theme between Chicago, New York, and San Francisco is these are all markets that really haven't seen nearly enough supply over the last several years. It's hard to develop in these large cities. And so if you're not getting new inventory, you're going to start seeing rent growth, which I find, interesting because New York City, San Francisco, and Chicago are typically large components of rent control and have, political messages of trying to keep rents low, although their policies are translating to some of the highest rent growth in the country right now. When we look at year-over-year rent growth by renters by necessity, it's a little bit of a change, not in a big way. New York City still takes the top spot. Kansas City is seeing some of the highest rent growth in the renters by necessity category, followed by Twin Cities, Minneapolis, St. Paul, then Chicago, Detroit, Columbus, and Philadelphia. Now, this is all year-over-year numbers. When we look at some of these short-term changes, we see a similar trend. Short-term U.S. advertised rents fell 0.3% month over month in September, with only 6 of the Matrix's top 30 markets posting gains. That means in the short term, really zooming in September, the market is mostly negative, really, with New York and San Francisco posting like the only really kind of above trend gains, followed by Philadelphia, Kansas City, Portland, Twin Cities, San Diego, Houston, Orlando, Baltimore, New Jersey, Seattle, and Los Angeles. A lot of other markets are seeing some declines, including some Midwestern markets. Yardi points out, maybe because we're speaking up about the Midwest so much here on the Gray Report, they have to knock us down at some point. Several Midwestern markets are seeing some declines, including Detroit, Chicago, and Columbus, just on a month-over-month basis. But as we mentioned, Chicago on a year-to-year basis is doing quite well. Even Indianapolis, one of our favorite markets, is suffering right now on a month-over-month basis from the lifestyle asset class category. Interesting piece that they covered on the Yardi report, which is really kind of piggybacking off of Harvard Joint Center for Housing Studies report, looking at some of the longer-term demand trends for the multifamily market. And they point out something that is worth noting, not overly to be concerned about, but it's certainly worth mentioning. And that is household growth, which is a key driver of multifamily demand, is, quote, is expecting to moderate in the coming decade. New households are likely to total about 840,000 per year, down from about 1.5 million annually over the last 10 years. They go on to say the ongoing drops in birth rates and foreign immigration are the main reasons household growth is slowing. And weak household growth may impact multifamily demand less than feared, though, because a greater share of new households are projected to rent rather than buy homes. So what we're saying is we're having less kids, our birth rate is going down, and our immigration has slowed down significantly. That is going to put a damper on new household formation. But maybe not silver lining, but the other side of the coin is because of household affordability or unaffordability, we have more and more individuals that are renters than previously forecasted. It would be nice to see that exact number of the growth in renter households to really be able to see what that how much that offsets that difference of almost 700,000 households, which would be basically what we'd be missing. The question that I have is, how temporary in nature is some of this data? How long? I think the birth rates is certainly a much longer term trend that's been going on in not just the United States, but developed countries across the world for decades. Immigration, on the other hand, that's a factor that's really shifted based on politics. We've had higher levels of immigration and then lower levels of immigration. It truly has changed based upon who's in office. And again, not to get overly political, but for to have sustained GDP growth and positive growth in this country, we do need to get our replacement rate up. And whether that's through having more kids or allowing more people to come to this country, if you just look at like the math from the economy from a just a pure number standpoint, we need more participants. And so if whether it's housing, whether it's other parts of the economy, it's something that policymakers and voters should really think about, of having some of a balanced approach to be able to have sustainable populations. The United States has a great thing going in that we are a developed country, but we can sustain some slightly higher rates of growth. We don't want to slip back and be regressive, and not being able to continue to have a moderate amount of growth that allows us to make longer term investments, to be able to count on those investments, be able to grow our cities, grow our states, and to have a tax base to pay for all of it. So again, not to get too political, but we need a couple more people coming to this country, or we need to have more kids. Now, I know there's a trend going on in the United States and probably the world to get that birth rate up. You hear Elon Musk trying to see how many kids they can have. To me, I don't know how much of it is that just a social media trend, or if that's actually showing up in the numbers. I would bet that it's more of a social media trend, but we'll see. Maybe in a decade or so, that birth rate goes from, whatever it is, 1.4 today. Can we get it up to 1.5, 1.6? Can we get it all the way up to 2 plus? Again, wherever it comes from, we're going to need some people to live in our cities, to do all the productive work we want to do in this country. And then there'll be people that live in the apartments that we buy also. So I believe it's